Good morning, everyone. Let me begin with a simple question. When we think of a charitable trust, what comes to our mind? Selfless giving, public welfare. An institution that exists not for profit but for a charitable purpose. Now, what if that same trust charges fee for its services, generates a surplus at year end, prices its offerings at a significant markup over cost? Does it still deserve to be called charitable? And more importantly, does it still deserve a tax exemption? That tension between charity and commerce is exactly what we are going to unpack today. What is the legal framework? Under the Income Tax Act 1961, charitable trusts enjoy significant exemptions, primarily under Section 11. Income applied to charitable purposes is largely shielded from tax. But the Act defines what qualifies as a charitable purpose. And that definition is the crux of today's discussion. Section 2, subsection 15 lists several categories: relief of the poor, education, medical relief, environmental preservation, and then, most broadly, the advancement of any other object of general public utility, commonly called GPU. Now, general public utility, that is GPU, is a wide net. Trade associations, professional bodies, urban development authorities, sports federations, all potentially fall within it. But Parliament was wise enough to add a proviso, essentially a warning label, which says GPU activity will not be treated as charitable if it involves trade, commerce, or business for consideration. Unless, number one, the activity is genuinely undertaken in pursuit of the GPU object, that is, general public utility object. And two, the recipient from such activity do not exceed 20% of the trust's total receipts in that year. Cross that 20% line and your GPU activity loses its charitable character, and with it, potentially, your entire tax exemption. The profit motive question. For decades, courts asked a single question when determining charitable status: what is the dominant object of the trust? If profit was incidental, if real goal was public welfare, the trust was safe even if it generated surplus. This came from the Supreme Court's ruling in the Surat Art Silk Cloth Manufacturers Association's case, which held that the test is not whether an activity results in profit, but whether it is carried on with the object of earning profit. Intent, not outcome, was what mattered. Under this framework, a hospital could charge patients, a trade fair organizer could collect gate receipts, a professional body could levy membership fee and still retain its charitable status, as long as profit wasn't primary motive. The comfortable position changed significantly in October 2022. The Supreme Court's 2022 shift. The Supreme Court delivered two landmark judgments, one concerning the Ahmedabad Urban Development Authority and another on educational institutions. In the AUDA case, the court effectively retired the dominant object test. Instead, it said, look at the nature of activities actually undertaken and apply an economic lens. The test it prescribed is this: if a trust charges for its services at a price significantly higher than the cost of providing those services, that markup is evidence of commercial intent. The activity is, in substance, trade, regardless of how the trust's objects are worded. And if the receipts from such activities cross 20% of total receipts, the exemption is gone. The court also directed assessing officers to scrutinize trust financials every year, not just at registration. An institution that was charitable last year may not be charitable this year, depending on how its receipts have moved. Think about what this means for a trade association that organizes an annual conference and earns substantial registration fees, or a hospital trust that opens a premium wing. Each of them now faces a recurring annual test, not a one-time clearance. The 85% rule, the second threshold. Even if a trust clears the Section 2, subsection 15 test, it faces another compliance hurdle. Section 11 requires that at least 85% of the income be applied to charitable purpose during the year. Fail to do so, and the shortfall is taxable. Under Section 115 BVI, income accumulated beyond the permitted 15% without proper authorization is taxed the maximum marginal rate, one of the harshest provisions in the Act. So, a commercially active trust must not only watch the nature of its income, it must also ensure that the bulk of it is genuinely spent on its charitable mission. What this means in practice: for any trust operating a hybrid model, part charity, part fee-based services, the message from Parliament and Court is unmistakable. First, map your activities carefully. Every revenue stream must have a clear documented link to your charitable objects. Second, price at cost. Any significant markup invites the inference of commercial intent. Third, monitor the 20% threshold throughout the year, not just at year end. And fourth, maintain the 85% application discipline. Good intention do not substitute for documented expenditure. The bigger picture, let me leave you with this thought: the tax shadow over charitable trusts with profit motive is not an accident of overzealous drafting. It reflects a deliberate policy choice. Tax exemptions exist to incentivize genuine public benefit, not to subsidize disguised commercial enterprise. The modern trust that blurs the line between philanthropy And business does not merely risk or tasks demand. Risk is something more fundamental, risk legitimacy of charitable trust itself. Thank you for watching. This is CA and IP Praveen Agrawal signing off. See you in the next presentation. The